Welcome to the brief from Mesh, the show where Mesh's team sits down with the experts shaping the future of digital finance.
Stablecoins are everywhere. At least you and I have been in this industry a long time, and that is literally true. We want to talk a little bit about the evolution of stablecoins and stablecoin rails. I wanted to get your thoughts because when I think about it, for a long time, stablecoins were a crypto infrastructure story. It was the on-ramps to crypto, it was the on-ramps to DeFi, on and on. In my mind, it's actually now evolving into part of major payment rails, into how money moves. Do you see it the same way?
Definitely. And I think this is such a critical topic because, to my mind, really where we're trying to get to is stable coins as money. Like, this is just another form of digital money and not just an on and off ramp to crypto, and that not being the only use case. And I think that's why we've seen such a proliferation across both the crypto and institutional space. We've seen so many different evolutions and iterations of new forms of digital money, and not just stable coins. Like, we also have seen, to your point, upgrades in payment infrastructure. So obviously ARC from Circle, we've seen with Tempo on Paradigm and Stripe with having a specific blockchain for payments. And then we also just saw last week, we saw JPMD being used on Base on a public chain. So deposits acting more like stable coins. And so I think that, to answer your question, we have seen that kind of surge in adoption and surge in development because it's not just about on and off ramps anymore. It is kind of the future of the payments ecosystem. And obviously, I'm sure you have thoughts as well about why we got there too, given developments in the US this year and where we're going.
It's a really good point. I fully agree with you. And it's interesting. We've often talked about what are the use cases for blockchain technology? And you probably remember 5, 6, 8, 10 years ago was we're going to tokenize everything. It'll be tokenized real estate. I'm going to argue that stablecoins are the most successful use case of blockchain capabilities. And when you mentioned some names, you mentioned Fiserv, you mentioned JPM's deposit token on Base. We're looking at PayPal, we're looking at Zelle, we're looking at Stripe, we're looking at some of these major players. We're starting to look at scale happening in the space. And you sit over in the UK and I sit in the US, and you and I have an opportunity to really look at the landscape. I would argue that part of the scale that we're seeing now really is from a regulatory clarity and an institutional comfort perspective. And I think the reason for that is, in the aggregate, a lot of these firms look at their long-term strategy and realize innovation's coming, we have to be part of it. Are you seeing that same dynamic?
Yeah, definitely. And I think, as you say, that point about regulatory comfort really cannot be underlined enough. And even though I sit in the UK, obviously we've watched what happened in the US with interest. And I think what's really critical here is that even though the US hasn't finished market structure and we're still waiting for genius rulemaking, there's still a lot of legislative work to do in the US. What has changed is that firms are no longer quite so afraid of the very, very long arm of the US law. And so that, coupled with the evolution of regulatory frameworks in other jurisdictions, UK, but also in Singapore, Hong Kong, Abu Dhabi, other major financial hubs, means that institutions feel, okay, we now have the go-ahead to get involved in these markets, to upgrade our infrastructure, to think about what the future of the payments ecosystem looks like. But obviously, there is still quite a bit of a fragmentation in this space as well. And while everyone tries to figure out what their project is going to be, I think that we will also need to see interoperability solutions and solutions to connect across the ecosystem as well, because there's still a lot of building in silos.
At least I'm with you and I agree. And you mentioned the regulation. And just to be clear, for anyone who might be listening to this, it's not perfect, but at least it's a bit of progress that I think is really important. And I think it really paints the picture of a future where what we talk about as traditional banking rails and broadly tokenized money rails begin to converge. And at least you and I have to talk about adoption. We have to talk about some of the regulatory and integration items. But is that a fair statement? And does that open up the wider financial markets to new innovations because of stablecoins? I'm going off script here.
No, I think you're absolutely right. I think that stablecoins are a great option for traditional players. And also, One thing that I would also kind of highlight and call out is that stablecoins aren't just an option for treasury management or what have you. Stablecoin issuers, a lot of them will also be clients of banks and asset managers. And there's a huge opportunity there as well. And I think that sometimes we forget that many major banks are also clients of each other. That's how this ecosystem works. And so I think that if we neglect that other opportunity for institutional adoption, we're actually missing a piece of the picture here, which is that, and it comes back to what you were saying at the beginning, stablecoins aren't just an on and off ramp anymore. These stablecoin issuers and their usability is truly achieving scale.
It's a really good point. And as we talk about that adoption, and in prep for this, for the record, anytime I get on anything with you, Elise, I make sure I prep because you know this stuff inside out. But when we talk about adoption, this clarity and the clearness from a regulatory perspective a little bit, and certainly institutional comfort means the more options. But more options doesn't automatically mean more adoptions. And the argument I've put forward is that's why these conversations about major money center banks, about major payment participants being part of this is critical, but that also means we're looking at a lack of standardization on some of these things. Let's talk about that a little bit, because what I think we don't want is a series of very large walled gardens in the stablecoin ecosystem. And Mesh plays into this space, and I think it's a really fascinating strategic fit. But you share that concern, and I wanted to ask also, given the proposed stablecoin framework out of the UK.
Yeah, so my take on this is that definitely this is why, and I've heard this number thrown about lately, and I do like it, which is that we're probably about 10 years into a 30-year journey, which definitely makes some people feel quite down. But I do think that it's true if you think about the evolution and the adoption across the whole of financial services. And to that point, when you have a lot of major institutional players either developing their own rails, their own networks, their own walled gardens, or their own coins, which may or may not be interoperable at this stage, that of course means that you do need to have some solutions and some market changes. And I think that this can come in a few forms. I think that frankly, one, we are likely to see a lot of M&A activity across the digital asset space. I think that's inevitable, but I also think it's the sign of a healthy and mature ecosystem. That's normal, right? And I think that while competition is important as well, and when I say M&A, I do not mean that all of the historic players should be snapping up the new ones. That's not necessarily it, but I do think some condensation and also then evolution and continued iteration will be good for the industry. To the point you make about Mesh as well, is I think that it's really important for there also to be players that are both network and asset agnostic. And I think that's where we don't see that many actually entering into that space and trying to connect the dots across these different institutions, across the different chains. And I think that's where firms like Mesh that are doing that have a really important role to play. And I think that, again, it will take a while for the ecosystem to evolve. And maybe you have some insights on that as well, especially given the work that you've done with large players over the years and in the traditional financial market space. I actually think that it's a good thing. That's the future we're working towards.
I agree with you, Elise, although I'm significantly worried about how gray I will be in 30 years. So I appreciate that. No, I think, a couple of things to talk about there. And you're right. I've been joking with the phrase, but Mesh becomes the glue for that interoperability. And we serve on the policy advisory board, so we see and understand what the use case and implementation looks. And I agree with you that large scale adoption happens because the larger institutional players are in it. But I also want to add a different wrinkle to this. And I want you to tell me if you agree or disagree. We'll need to get to a point where, from a stablecoin end user perspective, they should not only never touch the token directly, but at some point they won't even know it's leveraging a stable token. We've used the joke, you'll know blockchain or XYZ innovation has arrived, at least. And I think you and I spoke about this last time I was in London, when no one mentions it as part of a particular use case. Is that kind of naive of me?
No, I don't think so. Listen, if we took a sample size of the average population of the US, UK, EU jurisdiction, and you said to them, how do you think fractional reserve banking works? And
Right.
what actually goes on behind the scenes in your bank account? I am pretty sure that most people would be like, I don't know, but like it's safe there and it's great. And I can make payments with my card. I can make payments with my credit card and I can make payments with my debit card and I can move money quickly. And at the end of the day, that's what most people care about. And it's not actually that imperative that people are intimately acquainted with the underlying rails of the banking system. And I think that's going to be true for stablecoins and tokenized deposits as well. I think that while the words might be discussed, it may just be, to give a really practical example, let's say for the case of agentic payments, if you need to use stablecoin or tokenized deposits because your AI agent needs to make payments with programmable digital money, then you will have a card or an account that enables you to have stablecoins or tokenized deposits, but you won't necessarily think about it in the way of thinking about the mechanics of the stablecoin. The same way that people, when they first started making online payments with their cards, they weren't necessarily thinking about the mechanics of the card. It was just like, I can't use a check to make an online payment. I need to use my card instead. So I think that's probably where we will progress to. And I think that is, I definitely agree with you. I think that's a good thing. I don't think that we need every single person in the world to be a coder or a developer for DLT and blockchain to scale.
The same way I'm not a mechanic, but I expect my car to work and I don't know how it works. At least it's a really good point. And we brought up yield earlier as well, which brings me to something we put as part of the outline, which was really the competitive landscape of this. You know, you mentioned Genius Act, which specifically bars yield from payment stablecoin providers in the US. There is a kind of an argument, and some of the banking industry has pushed back. You probably saw this as well around that doesn't exclusively prohibit other firms that are tangential to it that might be able to do it on behalf of these providers. I think that's a nuanced policy conversation. But if we take yield off the table for a second, my belief is that the competitive advantage for stablecoins and the providers of stablecoins will be in distribution. Those platforms that are most distributed to the most rails, the most wallets, the most platforms and use cases. And again, I'm going to pitch the book of Mesh, but when you're going to look at a platform that enables the glue to connect all of that seamlessly and agnostically, I think that's a powerful model. But is that the right competitive landscape to look at, or are we missing something? Are we going to see these new startups that pop up that just disrupt the entirety of payments, for example?
So you raise a couple of really good points here. First, around the competition angle, I agree. I think that the competitive edge of digital money is in its speed, its programmability, its ability to be used on a cross-border basis. I think those are all really fantastic things. And also lack of transaction fees. That's not something that's actually baked into the stablecoin business model, and that's for good. That's a better consumer and institutional outcome. Coming back to your point about yield, I think it is important that we differentiate between payment instruments and also investment products. That's my personal view. I know there are people that might disagree with me on that, but I do think that is an important distinction. And the way that we went about discussing this in our response to Treasury was that you can actually differentiate here between interest, yield, and rewards, and that interest is on a contractual or periodic return on the basis of the time value of money, like coupon payments or bank deposit interest. Yield instead represents rates on market-based performance or price movements. And then rewards, that can be discretionary, opt-in or promotional benefits that are offered to users, like you might get credit card rewards. You might get like a toaster or like free Apple TV, I don't know. But I think that distinguishing between those things is really important. And rather than thinking about, okay, it's a blanket prohibition on anything being offered back to stablecoin users, I don't really see a reason why they couldn't offer a compelling reward to their consumers, so long as it's obviously distinct from those other types of products. So I think there's plenty of room here for stablecoins to compete. I think that there's still room for tokenized deposits and traditional deposits to compete. And at the end of the day, my view on that from a competition lens is that actually digital money should be encouraging both digital financial services and traditional financial services to be better in their offerings. Like, how can we offer better products to businesses and to retail customers?
I fully agree with you, Elise. The only thing I'll add to that, and I absolutely see the intellectual argument about yield versus interest versus rewards. And for the record, bringing up a toaster, like the old banking days where you opened a bank account and you got a toaster, is quite a flashback, but it's nostalgic. I will add one thing to that, though, and particularly for the organizations becoming part of the stablecoin ecosystem, that does implicate a series of different laws and regulations depending on how those are branded. So when you talk about states where it becomes not just the federal legislation, but now you've got 50 states around, are you now doing banking? Are you now doing payment services? So I'm with you from a utility use case basis, and what does that mean from a rewards perspective? And I think maybe market structure clears some of that up, but I think it's an important point that you make. I think the thing I've been focusing on a little bit when we look at competition is liquidity concentration, which is a concern to me. When we look at these really giant stablecoin participants, when you look at some of the TradFi organizations getting deeply involved, are you concerned about that kind of liquidity concentration? I see innovation as a way for new organizations to minimize that kind of concentration, but it's still a concern, isn't it?
Definitely. And I guess maybe this is, I'm gonna have to contradict myself when I talked about the M&A, but I do think actually there's avenues for both here. Is that I think that on the one hand, while we will see M&A, we also definitely should see less concentration, especially hopefully in the stablecoin ecosystem. I think that obviously as 99% of the world's stablecoins are dollar backed, I personally don't think that for the long-term future, that is the way it has to be. I think that we have a lot of other currencies. We have a very healthy and thriving FX market around the world. I don't see why we also shouldn't have other currency denominated stable coins, as we also see other frameworks for stable coins come online around the world. And so I agree. I actually hope to see some of that concentration risk in terms of stable coins fade a little bit as the ecosystem matures, and also as other options enter into the market as well. So again, I think when it comes back to healthy competition, there should be healthy competition across TradFi, across DeFi markets, but also thinking about how we can just continue to offer better products for the consumer and businesses. And again, that might be specific and nuanced in different jurisdictions. Like a competitive product for somewhere in Africa, like Ghana or Nigeria, might look very different to a competitive product that's needed in the US. And I think we need to be mindful of that as well.
Agreed, Elise. And I think one last thing I'll add to this kind of competition conversation, and I don't think it's a contradiction. I agree with you. There'll be M&A aspects within the market, but I also think, and I've been spending quite a bit of time thinking through the corporate partnerships possibilities of stablecoin, meaning the ability to, in a new way, create incentives that might not have existed before and partner with issuers, candidly partner or onboard and be part of, we're talking about Mesh and part of PAB there. Corporate partnerships to me encourage volume and liquidity as well. I guess the question I've got is, does this upset or evolve the world of rewards and incentives for corporations?
And maybe they do. And I don't know if that's a bad thing either. But I do think, coming back to your point, that this is where it will be very important for legislators and regulators to think as well about where they draw those lines, and also where we set out a level playing field. And again, as well as one that's interoperable for consumers as well. I don't think it's a healthy ecosystem if they have to be thinking about, if I use this stable coin on this particular chain, or if I use this particular asset on this particular network, then I get rewards or then I don't. Again, then I think we're muddying the waters of payment instruments in the future of money. Like, money still needs to be money and not have a bunch of additional considerations that come with it. And customers, either from a retail or institutional perspective, need to be able to have that certainty. So again, I do think it comes back to clear legislation there. But I also wanted to talk to you, maybe for our last topic of discussion, I want to talk about integration, and coming back maybe to something we mentioned at the beginning, which is, if we have all of these companies coming out with their new projects, new chains, new networks, does that actually equal more moats and more fragmentation? What does that mean for at the end of integration and the roads we might need in between?
Yeah, this is an interesting challenge, and it makes sense from a franchise perspective. These franchises want to maintain their walled gardens. They want the moats around their particular ecosystems. And I understand that, but you and I know moats are essentially, attacks on developers and technologists. They're attacks on, or penalty or fee on enterprises and users. They're ultimately attacks on end users as well. And there's no sort of open banking framework for all of this. It really does bring us back to a couple of different things. I think when we talk about in the US Genius Act, when we talk about potential market structure that defines the usable rails there, I think it really becomes a question of what are the platforms that enable and minimize the friction. It brings me back to the old gold rush conversation, and at least you and I probably use this kind of analogy many times. The most capable and profitable participants were the ones who supplied the tools and removed the friction. Integration capabilities, again, let's pitch the book of what we're trying to do with Mesh. Removing the friction and making it agnostic across all of those interoperability capabilities is part of the evolution of this marketplace. I can't imagine, in the absence of some type of open banking framework, which I don't see happening anytime soon, that level of integration across all of those modes is going to happen because of these capabilities. And I think it brings us back to what are the ecosystems that survive? What are the stable tokens that survive? The most efficient, the cheapest, the most effective, with the most incentive-based capabilities. That's how I've been viewing it as this kind of ecosystem evolves. I'd love to hear you tell me if you agree or if I'm missing something.
No, I think you're right. And I'm thinking about how long it took for us to get open banking in the regular banking sector. I agree. I think we're a long way from seeing open banking provisions in the digital ecosystem. But I do think that we can definitely learn some of the lessons from that legislative hurdle and from the discussions had with firms. And actually, I think that a lot of the institutions that actually think about enabling that interoperability up front before it's mandated in the legislation and how they can actually support that connectivity, that's actually a strategic growth opportunity for them, because having that connectivity, that actually gives you a competitive advantage rather than being a walled garden. You're actually connected out to the broader ecosystem. And in a funny way, it comes back to the ethos of coin and the crypto ecosystem in general, which is about connectivity and decentralization. And so actually it's getting back to the heart of that, but in a way that also can support the compliance outcomes that firms are going to need to meet in order to be operational within jurisdictions.
Yep, and I'm going to do it, Elise. You'll have to forgive me, but you opened this Pandora's box earlier by bringing up agentic. I've got to argue that AI capabilities and agentic AI plugged into stablecoin ecosystems will almost mandate the need for interoperability.
100%.
You can't imagine building in additional friction in agentic AI simply because there's a different toll structure or fee structure or interconnectivity with a particular walled garden. It just won't work that way.
I agree. And I think as well, you're already seeing this happen. And we see discussions in the news about how obviously AI search engines, when looking at commerce platforms, that commerce platforms are going to, in some ways, need to make themselves interoperable with agentic systems that are searching for various products, or those products won't be picked up and it will be to the detriment of that particular commerce brand. And so I think in a similar way, I agree with you that with financial services and the continued scaling of agentic AI, it will be essential that digital money is made programmable, that it's made interoperable and network and asset agnostic, and how they can interoperate with each other.
Yeah, Elise, it brings us to the mesh conversation. Mesh is that glue layer that I've brought up before. Yeah, and when we talk about chain agnostic, asset agnostic, network agnostic, in particular, it makes me think back to my old days on Wall Street, where there was really a mental overhead of who do we plug into? Why do we plug into them? Does it make sense to plug into them? Do they have enough liquidity? And it strikes me that the mesh platform takes that away, takes away the concern about how to make those determinations. Is that a fair assessment?
I think so. And I think that, again, it does come back to what we talked about at the beginning, is that we need to be thinking about what the solutions are for fragmentation. And I think it's absolutely understandable that large institutions, as well as smaller institutions, are building solo at the moment, because obviously they're trying to do what's best for them. They've looked at their internal risk management processes, and they're like, this is what we're going to build, this is what we're comfortable with, and this is what we think benefits us. But coming back to what we were saying before, there has to be that connectivity with the broader ecosystem, or you're never really going to be able to have that digital project scale, because the true success of, to my mind anyways, the DLT ecosystem and digital assets is in their ability to be faster, cheaper, more transparent, the cross-border usability, and you can't have that without interoperability. So I definitely think that there's a lot of ways in which mesh can solve some of those challenges, and I'm excited to see where it goes.
I am as well. Elise, it's always a privilege chatting with you.